Buy dips, not bonds, says my next guest, Darell Krasnoff of Bel Air Investment Advisors. He's going to tell us why. Welcome, Darell. Now, the stock market had a great year last year. It's off to a good start this year. So are you getting a little bit greedy here?
We think there's still a ways to go in the stock market. Valuations are still cheap relative to historic averages. There is very little return in the fixed income market. Not many of our clients are happy getting a 0.5% or 1% return to stay safe. I think the Fed's doing their job. And earnings, while they're growing slowly, multiples are still pretty below historic average, and we think there's probably still another year or two of decent market returns ahead of us.
You do see some headwinds, though. One of those is that maybe Wall Street analysts are a little over-optimistic with those earnings forecasts, right?
Yeah, so our premise is not that earnings are going to drive us forward so much, and we think that there could well be some disappointments going forward. Top-line revenue growth has really slowed. The economy is not really strong enough to drive earnings to the degree that it has historically in recoveries off of previous recessions. So it's not going to be an earnings-driven bull market. It's more going to be the reduction of the premium that investors have required for risk. And as things get better in the world, and there's still risks of that too. There could be problems in Europe. We still have to deal with dysfunctional politics in Washington. So there's still many things that could go wrong. But our view is if things get a little bit concerning, that's going to provide an opportunity to get in as opposed to a reason to be out. And
your view is also that you like dividend-paying stocks. Like which ones?
Well, so we like the big multinational types of businesses. Johnson & Johnson is a good example. Microsoft, while it's kind of been boring from a technology point of view, a great cash flow producer. So multinational, large cap. The growth in the world is not coming from the U.S. or from developed international. It's really coming from emerging markets. So we want businesses that can grow as a result of growth happening offshore.
And in order to buy those dips, should you sell your bonds? Because a lot of people are worried about a bond bubble brewing.
Yeah, so we've recently just shifted about 5% in our allocation targets from fixed income into equities. And our view is you ought to have short duration on bonds. You will be lucky if you can make your coupon on high-quality bonds, as interest rates are likely to be rising over the next year or two. There's still a lot of room before inflation becomes problematic because of all the excess capacity in the economy. But still, we want to be out of the way of the inflation tide as it comes. So we're comfortable reducing our exposure to low-return, high-quality assets and taking a little more risk. The Fed is underwriting risk-taking. And as long as you've got the Fed behind you, we think it's likely you'll be rewarded.
Buy dips, sell bonds sounds easy to me. Thanks a lot for coming on.
Pleasure.
And thank you for watching The Street.